So I am John Cheffers, the Director of Research at Watchdog. And here we discuss different interesting things that have to do with the financial markets and transparency. Today I am joined by three esteemed guests. First, there's Mark Jeffers, founder and chairman of the board of Watchdog. Mark is the former CEO of Audit Analytics, an independent research company that has set the gold standard in financial disclosures. He also has an extensive background as a fraud and insurance investigator. Mark also worked for PwC, KPMG, and graduated from Harvard Business School. This year, he was given the Distinguished Service Award for his contributions to the accounting profession. And he's also my father, which may be his greatest achievement. Mark, go ahead and say hi.
Hey, how are you guys doing? Happy to join you.
Next, we have Brian. Brian is the president of Watchdog Research. He worked at the New York Times Company, IBM, American Airlines, and started and ran several online information businesses. He also has an MBA from Harvard Business School and a business degree from Texas Christian University. Just say hi, Brian.
Hey, guys. Nice to be here as well. And congratulations again, Mark, on your Distinguished Service Award. We're very proud to have that.
Yes, congratulations.
Thank you very much. I was quite surprised.
And finally, we have Joe Burke, who's our data scientist, Excel wizard, math guru. He has a PhD in mathematics and worked as a professor at Ave Maria University before joining Watchdog.
Economics, actually, PhD in economics, but yeah.
Economics, okay.
Well, lots of math there, so that's understandable.
All right, so today's topic is Gray Swan Events and the Gray Swan Event factor. Now, Brian, since you're the president, let me just throw this first question to you. What is a Gray Swan event? And yeah, just give us a little brief overview on what that is. And let me,
sure.
Let me pull up I'll pull up something on my screen so people can look at.
All right. And while you do, I'll give a little background. I think most people know what a black swan event is on Wall Street. There was actually a famous book out called Black Swan. And a black swan event is something like 9/11 or even the COVID-19 issue or, the 2008 real estate challenge. And a black swan event impacts the entire market and usually leads to a significant decline. 20%, 30% of a drop in the overall market. That's why it's a black swan event. Nobody anticipates it. It sort of hits quickly, and when it does, it's devastating to the entire market. You take that as the foundation, and you think of a gray swan event, and you put the gray swan event into a single company, you understand what a gray swan event is. It represents something that the market did not anticipate well, that usually leads to a significant decline in that particular stock's price. So in this case, you could have companies that announce a fraud in their accounting process or in their management teams. Those kind of events are devastating, but there are many other such events. And Gray Swan events can also include things like a CFO suddenly departing. When a CFO suddenly departs, the question is, why did they depart? It could be a Gray Swan event, or it could be, unfortunately, a personal experience. And so we've put together in these Gray Swan event factors sort of a mathematical model, and I'm sure Joe will talk to this in just a minute, that outlines what are the probabilities of the most damaging Gray Swan events that are out there. A CEO suddenly resigns or is lost, a financial restatement, an auditing firm gets canceled from a company or resigns from the company. All of those are Gray Swan events because they lead to a damaging effect on the stock's price. And most people, again, when you think of black swan events, are afraid to anticipate what those might be. Gray Swan events are actually somewhat predictable. We know they happen with regular occurrences in all companies. And so what we've done, and again, I'll let Joe speak specifically to this, is we've sort of looked at what are the contributing factors that indicate a Gray Swan event is imminent. Imminent meaning sometime within the next 12 months. And then we use that math and we use historical price effects. And our Gray Swan event factor, which you've got up here, quantifies the risk for each company. And I'll wrap this up by just explaining that in layman's terms. And I use the example of car insurance. If I am rating two different car drivers for risks as an insurance company, I would rate an 18-year-old driver with 3 speeding tickets and a fender bender driving a male driving a red Corvette very differently than I would rate a mom who's 42 years old, never had a driver's ticket or accident in her life, driving a Caravan with 3 or 4 kids. Those are two very different experiential risks. And Gray Swan event factors try to take that same concept and look at companies and say, this company has a very tricky, dangerous historical record versus this company. And we can sort of anticipate which one of them, just like we can anticipate which driver has the higher probability of an accident and how damaging and expensive that accident might be. That is our Gray Swan event factors. So,
thank you, Brian. Now, there's a lot of information, obviously, that comes into a calculation like that. Mark, I'd like you to talk a little bit about about where the underlying data comes from, because you're the former CEO of Audit Analytics, and Audit Analytics is the main vendor for that information. Could you give us a little bit about where that data comes from, how reliable it is, and sort of how extensive it is?
Sure, John. The data itself has been under development at various different times over the past 15 years. It's data that includes all kinds of accounting, what I would call accounting irregularities and accounting effects, as well as other certain events that tend to indicate some sort of disclosure challenge. These can be litigation items, class actions. They can be things like like restatements or impairments or changes in accounting estimates. They can be associated with things like SEC comment letters. For example, our SEC comment letter database contains more than 330,000 correspondence between the SEC, the experts at the SEC, litigation, the lawyers and the accountants at the SEC asking questions about every kind of topic you could imagine. So the 330,000 letters in the taxonomy, for example, and that is about 4,000 items deep. Now you can imagine what kind of a breathtaking database that is. And it's a database that we grade, Audit Analytics grades through both an analyst and an automated system, so that all the main items in that database are all analyst approved. So it's unique in that regard. And one of the things that Audit Analytics has done over the years, and all the different data sets it has collected, and there are more than 30 of them, is that they have made them available to academics around the globe, as well as regulators around the globe, and as well as the accounting firms. Now, these 3 particular groups, academics, they pore through the data. Regulators who also pore through the data because they need to rely on it for public policy decisions. And the accounting firms are just plain old difficult, challenging clients to have because they have high expectations of the quality of data. So the data itself has been the data, the taxonomies have been reviewed, analyzed, and improved upon where necessary. And over the past 15 years among these particular very challenging customers. So the data is highly reliable, highly accurate. And that's what makes and it's also mostly analyst driven. In other words, almost all of the items in it, whether you're talking about a restatement and what kind of restatement, is it revenue recognition? Is it financial derivative? Is it inventory? Is it something else? All those things are highly accurate, and they make for a great source of data for the creation of something like the Watchdog research reports, as well as the Gray Swan event factor calculations. So with that, unless you have any other questions, I'll turn it back to you.
No, let's. I want to ask Joe about, and I've pulled up a Gray Swan event factor table. It's a table actually for a particular company whose ticker is HFFG. And Joe, I just want to ask you about, because it looks like the Gray Swan event factor, it's a forward-looking product. So how is it that you're able to take past events and actually make predictions about the future? Could you tell us a little bit about that?
Yeah, sure. So what we're looking at is an indirect measure of a company's accounting and governance risk. And the predicted probabilities there that are forward-looking are based on the red and yellow flags that you can read in our watchdog reports. The underlying cause of these flags are the result of corporate culture, accounting systems, and leadership. And these things tend to change only gradually, if at all. The truth is we are creatures of habit. We easily fall into a routine or a way of doing things that can become difficult to change. As a result, our past behavior tends to be predictive of future performance. So, like Brian mentioned, bad drivers tend to stay bad drivers, messy roommates tend to stay messy roommates, and risky companies tend to stay risky companies. So the flags give us a window into this process, and so we use multivariate statistical analysis to help us identify which flags are the best predictors. And then we have an algorithm that combines the best predictors into a mathematical formula, and that gives us our predicted probabilities. So it's an ongoing research program, and we're always looking for new ways to leverage the data and improve our algorithms.
Okay. So I assume that there's multiple, when you look at a number like the financial restatement number, 60% in the chances in the next 12-month forward-looking probability. That's not just one factor. You've got different factors weighing in there.
Yeah. Mm-hmm.
John, if you would, you can click that link, that financial restatements. This is our watchdog report. And if you click that, it'll automatically open to the financial statement restatement section of that company, HF Food Group's statements, and you can see any historical records. And you can go up and down in this to see if they actually have any that exist. This is a peer table that you can look at where their red and yellow flags compare to their peer table. These are the red and yellow flags Joe was talking about. Each one of these gets a certain weight as a predictive factor and as a sort of cost factor that goes into that Gray Swan event. And the two reports are interrelated. So you can move from one location, one report to the other very easily. And as you see here, where all the links are in blue, you can actually go to one of those. So if you would just go to, say, the mergers and acquisitions or any of these red flags, it'll take you to that specific spot in the watchdog report. And what's also important is we have links in this report that will take you out to the SEC filings so you can read for yourself the actual results. These are, I think you can click on either of those, any of those red flags there, or here you have an 8K link under there, right there, the 8K. You can click on that and it'll open the 8K that announced the change and immediately took you to the SEC. So not only do we pull it together, as Mark said, and then score it, as Joe has said, red, yellow, and green flags, but we've actually built in the system to be able to go to the original documentation, see it yourself, and compare peer organizations. So you can see, look, generally this is an industry that churns and burns through CFOs or CEOs or has significant financial restatements happening. Those are the things that we've incorporated into all of these numbers.
So let me ask you, Mark, because you've got a lot of experience in this industry and looking at a lot of these factors. Like, for example, you're looking at this chance of financial restatement. Does this jive with your experience in the field working on this kind of material and seeing these kinds of things?
Well, yes. I mean, the restatements, the kind of the percentage of times that a restatement occurs changes quite dramatically from factors like company size or industry or kind of challenges in the complexity of the accounting for a particular company. The and there are other such accounting changes as well. I don't know if you have the ability to just one of the main ones we pull up is GE. I don't know if you have the ability to pull up GE on this particular presentation, but if you go down to the share price timeline schedule,
Page 2 there.
you can see over on the left that we have a bunch of accounting, what I would call restatements or corrections. And you can see on the left that there's financial restatements, there's revisions, out of period adjustments, changes in accounting estimates, impairments, late filings, etc. Now, as you look at the 5-year history of GE, you can see, for example, that almost every year they change some number in their accounting estimates. If you go along that line, you can see little yellow items, and as you scroll over each one of those, you find out how much of a change in accounting estimate there have been, how often it has taken place. In addition, you'll find that they also have had a number of impairments. So if you look there, you can just the next line down, you can see that GE is over the past 5 years has had a bunch of impairments. So they're writing off assets that they either paid too much for or couldn't realize the value from. And then, of course, that there are some revisions, and they've also had quite a number of disclosure control issues. So if you go all the way over to the right, there's something notable, which is also something new. You'll see a red dot under the category of critical audit matters. And that is a new thing that's come about, which is something where the auditors actually independently opine about what they consider to be the risky areas. And the key audit, if you were to click on that button, key audit matters, or critical audit matters for the United States companies, you'll see that there are 4 critical audit areas that are identified in GE's audit opinion. One of the other things you'll note, and you can see that most of them have to do with revenue recognition issues and goodwill and tax provisions. So these are the issues that the auditors have said. Now, one of the interesting things about GE, if you go back to that chart, is that there's another red flag too. More recently, if you scroll down, that red flag, the latest one is
the auditor change.
Auditor change. And what happened to GE is that I guess GE didn't really like the critical audit matters that KPMG informed them that they had to report on, and in fact switched over to a new auditor, that being Deloitte, if I remember. Yes, Deloitte.
And if I remember, they had that auditor for something like 50 years. I mean, this is a massive change, right?
I think it's more than that, actually. I think that KPMG's been the auditor of GE for 100 years.
Yeah.
So there's in terms of looking at the different issues that come up with regard to the reliability of financials, what's taking place. You can see that GE is still, after several years now, still reeling a bit from
Hold on, Mark.
their own
Hold on, Mark.
challenges.
Just a moment.
That was GE. That was an engine from GE saying, "Whoa,
Yeah,
you're catching us here."
Train from the engine from GE. There you go.
Yeah.
So anyway, but if you were to go and click on the Gray Swan event factor for GE, you in fact would find that, and you went to the bottom part of that chart where we show the last 2 years of changes in the kind of the trend for GE. Actually, GE over the last 2 years has made, according to the Gray Swan event factor, has made significant improvements, if you want to call it something, in the reliability of their financials. Now with the latest, with the auditor change, that may change again. So we're not quite sure, but the whole idea is we want to look at those look at the trend of the Gray Swan factors. It's very important. And then look at how they compare to their peer groups. You can see the chart in the middle where GE is there at minus 1.15, and that compares to, for example, the one at the bottom there, Williams Industrial Services Group, Inc. We could click on that and go right to their Gray Swan event factor. And we could look at what things drove that factor and how they've seem to have come good again. So the Gray Swan event factor is designed to not just identify what the inherent accounting potential discounted risk is associated with the disclosure risks. It's also designed to give you a sense of where a company is going.
Yeah, and I if you went from this on the left there, the historical factors, and you see that downward trend, and you go back now to the watchdog report and the chart, this matches the number of errors, if you will, if you page down right. If you look on the left, you see significantly more yellows and reds more recently in the last year. They're starting to clean up their act, so to speak. And so the price is stabilizing. You've seen this sort of trend going down because these accounting risks are real. They impact the value of the stock price because it tells you that the management at that time is not properly managing the business. There are errors, there are statements they've got to clean up, there's problems that they're dealing with. And then as they deal with those, that sort of works its way through the system, the price adjusts, and those frequency of those kind of events slows down until you have another set of problems. And that's what we represent here with this chart and what Mark was showing on the decrease in Gray Swan event factor. All of this works together, but it all stems from these issues on the left. This is the accounting forensic specialist. This is what, if you think of a doctor looking at blood pressure and weight and heart rate and cholesterol scales and so on and so forth, that's what we have on the left. And this tells us how healthy and how stable and how fully disclosed and how honest, in some cases, management is. So great example, Mark, to pull all this together.
Yeah, by the way, the official number was 111 years.
111 years. That's
111 years of the same auditor before the final switch to Deloitte.
I like the way that Joe presents this with respect to the Gray Swan event, and the way that he talks about it, just in terms of, this is the inner workings. This is kind of I call it the soul of the company, the culture of the company. A lot of these, like it took GE for many, many years was the darling of premier, like their accounting would have been pristine. Their everything about them was highly tuned and highly run. And you do see this in companies. One of the things that's so interesting about so many companies is that their cultures do change from time to time. You bring in a new CEO, they change the strategy, they adopt different, they bring in new CFOs, and so what can happen with a company like GE is GE basically, what I would call, I've heard it described as that it's like the management they brought in was not competent, and they started harvesting the company. They're more interested in getting big salaries and big bonus payouts and stuff like that, and not maintaining the competitive significance of GE with all the different factors. And so what happens then is that when that happens, companies tend to inflate things or don't look at things as strongly as they want because they're trying to, satisfy, the different sector heads are trying to satisfy, the board or the CEO or whatever it is. And so
you're trying to reach certain benchmarks for your compensation.
Yeah, so it's GE is a great example of a company that had pristine accounting record, and then became complacent and seemingly playing a little bit fast and loose with some of the accounting reporting and some of the asset purchases, and then they had a huge, like several years of just devastating kind of loss of share price and value and changes, and then it's just kind of right now, it's still suffering a little bit. But if you look at those volumes of shares that are taking place here during this time period, the last 2 years of GE, it is just, you've got people betting on its return, and then people selling on, and then the decline is quite dramatic. So anyway, that's kind of, I like GE as a good example. There's a lot more of them like that. And
Well, thank you, Mark and Joe and Brian. I think we can probably wrap up our discussion here at the moment. I think that, I don't know, even I've learned something new today, which is great.
I'd like to ask Joe. Joe, do you have anything else to say about Gray Swan? Because you're really the developer. You're really kind of the brain behind the different statistical models with built. And
Yeah.
where's it going, by the way?
What's that?
Where's it going to? How do you see it progressing?
Well, I mean, we have such a rich data set, and we have some new flags that we've added this year in our corporate watchdog reports. We would like to look at, the impact of those and revisit some of the statistical models as we go forward. As I mentioned, it's an ongoing research process. So kind of getting as much as we can out of the data we have, and then audit analytics is very forward-looking, and so they're always adding new data sets. I mean, one of the things I think is sort of striking in my own research, some of the things we come across, that mergers and acquisitions number that's often very big, and it's just amazing to me. Look, because we did, I mean, thousands, I think, of these mergers and acquisition deals to come up with a number, and if anything, that number is frankly conservative based on what I've seen. There's a large academic literature on those risks. And the effects of mergers and acquisitions can last for years in terms of, I guess people think these things are priced in, and they aren't. And so it's striking to me, how many times are you going to keep falling for falling down the same hole? It's like Lucy putting up the football again, and Charlie Brown going to kick it. Like, okay, you see a big merger and acquisition. It's not been priced in typically. Heads up, that can have long-term consequences, and so just putting that there and helping someone who may be looking at a new stock. Oh, there was a big merger and acquisition last year. That's going to take years, and that's oftentimes does not work out in the shareholders' favor. So that's a big element that was it was surprising to me how large it was in terms of contributing to the Gray Swan factor. In the other regards, I think it's obvious a company that would have more red and yellow flags would have a higher risk. So just natural to account for those when thinking about the probability of a restatement, probability of a shareholder lawsuit. But I think most importantly, this underlying issue of accountability and trust. If you're investing in a company, you're trusting these people to, manage your investment, and not everyone is equally trustworthy. And so we would like to know how trustworthy and competent these management team is, and how much. And so we don't get we can't measure that directly. A lie detector test or something for everybody. We can't do that directly. So we have to get these indirect measures and make the most of them. And so really making the most of that data and making it in a useful way, I think has been our kind of vision. And anyway, so yeah, there's some issues I'd like to look at going forward that we hope to add those to the Watchdog report and the Gray Swan events. But we're
also, if I could add, we're also actually combining these. So I think most of our viewers would understand the concept of a pension fund or a portfolio, 100 stocks, 1,500 stocks. If you think of a portfolio manager, you think your parents' pension fund being managed by a teachers' union pension fund. Inside of that pension fund are a series of stocks, and those stocks have different Gray Swan event factors. And that's your retirement money. I mean, that's your nest egg. And those portfolio managers we are now producing a report. Joe's been working on it. The team's been working on it. And it's just now launching, where we are creating a Gray Swan event factor, sort of a weighted average for an entire portfolio. And then we can, a pension fund, for instance, and then we can break that down and say, these are the top 10 worst performing stocks that have the highest risk. And whether they're pursuing that is something that the portfolio manager needs to evaluate. But a pension participant or a pension oversight board member should be looking at those worst performing Gray Swan event factor stocks and saying, should our pensioners be in this stock or should they not?
Brian, I have a question for you, because I think it's important that anyone who's listening to this understands that Gray Swan event factor is not about determining whether a company has a great, say, technological advantage, or whether they're competitive in an industry, or all those operational factors. That the Gray Swan event just factors on one narrow area. And I wonder if you could just talk about that a little bit.
That is exactly correct. I mean, there could be a company that has developed, I mean, Tesla's a terrific example. They've got absolutely a wonderful brand, a great technological lead in their particular space at a time, by the way, when the automotive industry is undergoing some terrific changes. You see, I think Tesla's stock is alone worth more than the sum total of all the other auto manufacturers that are out there, Ford, GM, Chrysler. And that's because Tesla has some outstanding technology and business strategy. However, none of us are probably unaware that Tesla's CEO and the SEC have kind of crossed swords. And he plays a little bit loose with some of the SEC oversight and regulations, and they're working through that. But we're sort of saying that's something you need to be watching. You absolutely, as an investor, need to understand their strength. You need to understand electric vehicles. You need to understand how they are vis-a-vis their competitor, where they're going, their new pickup trucks, their new big semi trucks. Great opportunity ahead. Going into the Chinese market, great opportunity ahead. But do not ignore the real risk that's over here. This risk over here might be massive, or this opportunity might double or triple the stock. But if something happens over here, and one of them, in this case, is the loss of a CEO like Elon Musk. I mean, if Elon Musk ever left this company, whether the SEC forced his resignation because of SEC violations or not, that stock would take a massive hit, a Gray Swan event. And that's what we do. We focus here. We're helping you keep this focus, because most people tend to focus over here. Most people get seduced by the excitement or the storyline rather than the blood and guts sort of blocking and tackling that has to be done over here.
Brian, would it be fair to say that it's not necessarily the greatest idea in the world to get absorbed by whatever the hype is on a particular company like Tesla, if there's a question about whether or not what they're reporting or what they're disclosing is accurate? Because you always have to say, okay, what information am I not getting? Because the culture at Tesla has been one of playing fast and loose with a lot of different accounting related issues. And I know that, for example, John did several blogs on the challenges associated with the accounting and disclosures at Tesla, and that kind of culture, it's something that you always have to say, okay, well, what? I mean, I go back to Enron, the days of Enron, when Enron was named the most innovative company in America 5 years in a row by Forbes or whoever it was, and you have to ask yourself the question, yeah, okay, great. That's that shining object, run after that one. But the disclosures were impossible to understand. They were opaque, and something that, that a number of us took a long time to figure out. So anyway.
And we actually have a measure now on our corporate watchdog reports on accounting complexity, exactly because of this. It's that famous saying that this time is different, and human nature, we want to fall for it. this time is different. And the truth is, human nature doesn't change over time. And there are, and again, just to be very clear, we're not saying this about Tesla. We're saying it has some of the excitement and the enthusiasm and the market sort of momentum that seduces people to believe this time is different. And we're the guys that are sitting here saying, as with Joe's work and the 15 years of audit analytics data we've got, that actually it may not be different. And we're actually going to quantify it for you. And we're going to hold a mirror up and say, this is the truth as we see it. And sometimes the truth is ugly. And sometimes, you know, it doesn't overwhelm the opportunity, but that's our job. That's what we do. That's what John does specifically on our blogs very well. Anybody who hasn't read it, strongly can suggest you look through our website and not our blogs.
One quick point, you know, we're an independent research provider, so we're not trying to buy. We don't make a commission off of anybody buying or selling or holding anything. So we're independent, objective, yeah, so just giving that. And also look on issues that as people don't, we understand people have limited time, resources, and a lot of time research budgets are being pinched in a lot of financial institutions. So doing this kind of research, doing the kind of hard research of looking at accounting disclosures, and we're here to help you make that easy and use your time efficiently. So we're independent research provider and help you, like you said, get the most for your research time and research dollars.
Yeah. Well, thank you, Joe, Brian, Mark. Really appreciate it. I think that we'll wrap things up right there. Thank you very much.
Look forward to doing it again.